position. So now you're going to have an average, you'll be legging in on an average basis to get up to your stated number that you need in your portfolio. So that's another way to treat this.
Okay.
But I have never, again, even since the 70s, and in the 70s we had inflation at 18%, 79, 80. I've never used the format of trying to scare somebody into an investment. You need to understand what you're buying, what the volatility potential is in that investment, and you need to be comfortable with it. And and if you buy it at $12.85 and gold's at $12.65 in a month from now, you shouldn't be angry if your mindset was that I just need this as a piece of my overall portfolio, because if gold does go to $12.65 over the next month, it's likely that the other balance of your portfolio, your equities and your bonds, are probably doing better. The economy is doing better. Everything is in a perfect world where everything is working well. Your real estate is holding value. Your equities are going up. Your bonds are giving you at least some kind of a yield. The last thing you want is gold to go to $1,800 because that's going to indicate that the rest of your portfolio is probably going to get hammered.
Sure. No, that makes perfect sense. Let me ask you this, just looking back, and I understand it's a trader's perspective, but, gold has struggled over the last year. It has a negative return of, 3.6% or something like that as of this recording. And over the last 5 years, it's down also. And I know there's been buying and selling opportunities from a trader's perspective all along the way. But why do you think gold has struggled over the last year and even over the last 5 years?
Okay, well, if you look at the movement of gold from 2008 to 2011, when we were sort of right in the meat of the financial crisis, what the Fed did was, and in fact all central banks in the world did, was they ratcheted their rates from sort of a benchmark of around a 3% yield. They ratcheted it down to zero, and in fact in Europe they went to negative yield. And in that context, the dollar got hammered. And gold, as any general commodity, is usually traded in terms of dollars. And with the dollar weakness, because of that huge QE program that the Fed embarked on in 2008, created a movement in gold, and then you added the fear component to it, and gold took off and went to $1,900. I think gold probably, just on a dollar basis, should have maybe peaked at about $1,400, not $1,900 back in 2011. That last $500 was strictly just absolute fear.
Right.
But since then, since about 2014, the Fed has made it very clear, and they've been very transparent, that they are going to tighten their monetary system. So first of all, they abandoned QE, then they started to reverse on some of their bond transactions, and they've been raising rates. And rates up on a basis over the last 4 years, including the bond transactions, have gone up almost 4% in the United States. And that has created a huge flow of money, both into the equity markets and into the dollar, which has been negative for precious metals. And so you've had sort of a bear market in gold since 2014 from the $1,900 level. Now, from a trader's perspective, there's been ample opportunity to pick up 20%, 30% in these markets. When you look at the low of 2016 at 1,060, gold from there rallied up almost to $1,400. Then it went down to 1,140, rallied up almost to 1,360. Then August of last year, it was at 1,170, and it rallied up to 1,360, almost a 13% increase. So from a trader's perspective, there's been really great opportunities to buy, to make money in this market. And, the other thing, and again, this takes a bit more of an aggressive type of mindset, and also somebody with a higher risk profile. Everybody seems to complain that the banks or the governments are controlling the price of gold and they're forcing it lower. Well, you certainly have the opportunity in the gold market to play the game. I mean, you can go short this market. You can go on the COMEX and you can short gold.
Mm-hmm.
You don't always need to be long. So if you honestly believe that the market is being manipulated lower, you can participate in that. I just think most people believe that they buy gold and they expect it to just fly all the time, and that's just not what gold does. There are times in our history, 92 to 02, where the gold price moved in a $40 range for 10 years.
Yeah, that's incredible.
There's just times when it's a lousy investment, and then there's times when you really need to be a bit more aggressive with it and be a bit more exposed to it. Right now, I think we're sort of right in neutral territory, and I'm not suggesting gold can't go down from here, but over the next 5-year period, I think a $1,280 gold price is going to look cheap.
So, thank you for that. In the time we had left, I just wanted to get your thoughts on the following subject. Is gold has long been considered a hedge against inflation. Do you think that is still valid, or has that, in your mind, changed?
Is gold still a valid investment? Is that what you're asking?
No, valid as a hedge against inflation. So if I have concerns that inflation is going to increase, is gold a good hedge against that inflation fear in today's marketplace?
Yeah, I think, again, having been in this business since 74, you always hear inflation is really good for gold. And it is, but it's not because it's inflation. Generally, when you have high inflation, you have a dollar that is getting hit.
Okay.
That's great. The dollar suffers because it just tends to be negative for the dollar. You have less buying power with your dollar, and that in and of itself creates the positive influence on the gold price. And then you correlate it and say, well, it's because of inflation. Well, inflation was one of the reasons the dollar dropped, but there could be other reasons why the dollar drops. And I think just in a general format where there's dollar weakness, that generally tends to be a good catalyst for gold.
So I want to thank you, not just for being on the show, because I am thankful for that, but you just taught me something that had puzzled me, because in that financial crisis time frame, I owned for my clients gold, and the thought during the financial crisis, or at least my thought, and I think it was fairly prevalent at the time, was that with the Fed's activity, with the financial crisis, we would likely see inflation. And so we increased or began allocations in gold, and we did really well with our positions in gold, but we were wrong on our thesis because we didn't get much, if any, inflation. But we did get what you just described, which was the dollar went down, not because of inflation, but because of other factors, and you solved the puzzle for me. So thank you very much.
You're welcome, Chris.
Final question is, it seems to me that gold, and you as a trader know much better than I, you could, I think, make the case, or at least I've made the case, that it in large part it's a proxy for your confidence level in the central banks. You mentioned Draghi early on in this conversation, who's in charge of the central bank in Europe, but it seems to me that if you had a degradation in the confidence level in either the Fed or Europe or other central banks around the world, but especially in the U.S., that might be a driver of the price of gold, where now the consensus seems to be the Fed's on top of things. Maybe they are, maybe they aren't. But is that a good way to look at gold in terms of potential short-term drivers of price up or down?
Yeah, well, you also have the geopolitical issues too. I mean, you don't know. North Korea could raise its ugly head again, and Iran's always sort of sitting off on the sidelines there. You've got the Middle East, which is, in my opinion, still a mess. You have potential. I mean, just look at Deutsche Bank. It's trading at $7. I mean, the financial system in Europe looks at best shaky.
Sure.
So, you have there's a lot of things that can go wrong, and in that context, having an allocation to gold just makes sense.
Beautiful.
You've got central bank buying of gold, the highest level it's been at since 2004. You've got some of the guys that have got big money, like Soros and people like that have never really liked gold, that have come out over the past, even Jim Cramer. I mean,
that is true. He's completely
come out over the past year, and they're all saying, guys, look, this is starting to feel nervous to us. We would recommend considering some allocation to gold. I mean, I've never heard these guys ever, some of these billionaires come out and suggest putting some of their money in gold. So when you've got big money and smart money, I mean, these guys know what's going on. If they start allocating to gold, I mean, God, guys like us, I mean, we should at least pay attention.
Beautiful. Well, for listeners who'd like to get more information about Peter, his last name is Hug, H-U-G. He contributes daily commentary and market insights for millions of readers. You can go to Kitco, KITCO.com each month to get ongoing commentary from him. That's a nice way for people to follow up with you and get ongoing thoughts, right?
Yes, and I mean, they could... you can email me directly if you have any questions. It's phug@kitco.com. I promise you I will give you a response. I can't promise you it'll be the same day, depending where I am and if I'm flying around, but I will get back to you.
Very good. Again, Peter Hug, thank you so much for your time. It was a great discussion, and hopefully I can have you back on the show in the future. It was really terrific.
Great. Chris, it was a pleasure. I really enjoyed being on your show.
All right, thanks. Have a great day.
Same to you.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.
Simply Financial is part of the Exvadio Podcast Network. You can find Exvadio podcasts at exvadio.com/podcast, the Apple Podcasts app, iTunes Store, iHeartRadio app, Spotify, Stitcher, and wherever you find podcasts. So join us and stay informed and entertained.